Hi there, folks. It's James Marley here, co-founder at Livewire Markets, and welcome to this interview where we're going to be diving into some of the opportunities in global markets, particularly in the US. And joining me to talk about some of those opportunities, I've got Bob Desmond, who's the Chief Investment Officer at Claremont Global. Bob, great to have you in here. Good to catch up.
Hi, James. How are you going?
Doing really well. I hope you've recovered after last year. I understand you had a really busy year. You bought 4 stocks.
It was very tiring, James. I took a good break at Christmas. Yeah, I'm well recovered. Thank you.
Probably not the picture that people think of fund managers. Your job is to look at markets for opportunities all day, every day, but you only found 4 compelling ideas in 1 year. Tell us a little bit what's behind that.
So what tends to happen, James, is we will often follow companies for years. Getting to know them over time. But the more important thing is the entry point. So you have to wait patiently for the right multiple to buy them at. And so last year there was some bifurcation in the market. Some sort of quality names got left behind. Obviously there was a lot of momentum in the market and the action was crowded in a few names. So that money's obviously left some of the other names. So some of the stuff we've added to the portfolio, some of them not such well-known names. We added Amazon, that is a well-known name, but 3 of the others are not really household names. They got left behind. They got to our buy prices. We bought them.
Yeah. And how did you find that environment where you had that bifurcated market with a momentum-driven part of the index really leading the charge? There must be an element of temptation or frustration as you see those high flyers fly higher.
It's probably neither, to be honest. We just follow the same process always. Bifurcation normally for us is good because you get price movements. Because we are so value disciplined, we want prices to be moving around to get them into our buy price discipline. If I had to characterize the year, momentum for us generally is going to be tough when you've got a real trending momentum market, and you can actually, in some of our presentations, you can see we track Claremont versus momentum. We will find performance-wise, that's going to be a tough market for us. But the converse is actually, hunting-wise, it actually tends to be quite a good year. Like last year, we added 4 names.
There are a number of factors that can go into, valuation of companies and indices. Earnings, I'm sure, is one of the stable ones that you follow. But sentiment and the multiple, I guess, is another one, and it can move things around quite dramatically. Keen to understand what factors or indicators you follow to get a sense of what sentiment's like in the market at any point in time, and I guess what are you reading at the moment?
I mean, it's not particularly scientific. So valuation's obviously a great point to start. So you can look at the S&P 500 and go, well, 22 times is well above the 20 average of 16 times. So yeah, animal spirits are alive and well. We're not at the 26 times we saw in the dot-com bubble, but we're up there. Multiples are elevated. You can look at spreads. I always like to look at spreads in the credit markets. The credit market's always very smart. They're very tight, tight as they've been in some time. That'll give you an idea of where sentiment is. I mean, it's more fun, but I do look at things like Bitcoin. Bitcoin's my new risk indicator to see where the market's
proxy,
at.
Yeah.
It's a good proxy. We in the old days we used to look at the VIX, but now Bitcoin is a good. Suddenly this just took off 50% when Trump's election. It's like, whoa, that's. I think animal spirits are alive and well. The one area which has still quite muted, which is quite interesting, and normally heralds close to a top, which you will see is the IPO market, and that's actually still quite muted.
Yeah.
Now, I wouldn't read anything, but those are the sort of things I tend to look at to see where the narrative is. So I would still say, valuations are full and animal spirits are alive and well. Although the last few weeks, as you say, with some of the tech earnings, the CapEx budget, some of the tariff news, some of the geopolitical news, that I think it's kind of just causing a bit of uncertainty. Yeah.
Bob, we talked a little bit about the acronym, the MAG 7. You don't like bundling them all together, but the reality is it's been a hard to ignore part of the market, particularly for a global investor.
Yep.
How have you approached that collection of companies, and what are some of the ways that you've tried to break it down and separate the collective to individuals?
So in technology, what we do like are established monopolies that have network effects. So we have Microsoft, obviously very dominant in business software. We have Alphabet, completely dominant advertising business. Again, network effect there. We have Amazon, which is half consumer, half AWS. So we look at it business by business by business. I think the areas in technology where we tend to stay away from, so something like NVIDIA, been a terrific performer, but that's kind of an area we're not really that comfortable in. A couple of reasons. I've been asked this a few times because obviously it was such a big part of the performance of the index last year. One, semiconductor cycle, they can be quite cyclical, semiconductors. And then the product life cycles can be quite fast changing as well. So if you think of NVIDIA, where 5 years ago it wasn't really a household name, people knew about it, it was big in gaming chips, and then it's kind of come from nowhere to sort of be a 3 trillion market company. So that for us is probably a little bit too exciting. Something like Tesla, been wrong for so long on this one, probably be wrong for a lot longer. But for us, it's again a product company where someone can recreate that product. What is much harder to recreate are ecosystems or network effects, and where you've got businesses that have ingrained habits, that's where we tend to go.
Yeah. Well, let's dive into a couple of ideas. You hunt a little bit further and wider. You mentioned a little bit earlier that you find some stocks that are not so much household names. What are some of the really compelling alternatives in global markets to some of these big names that people would be really familiar with? What have you uncovered?
So if you look at some of the names you brought in last year, so we obviously have the big ones that are 3 trillion market caps, but we can drop down and right down into 3 billion if we want to. A couple of names that your viewers might be interested in. So one of the ones we brought in last year is a company called Jack Henry, which does banking software for banks, smaller banks in the US and credit unions. So if you're a smaller bank, you can't have a dedicated technology department like say CBA does and do all your own technology bespoke. You want to buy it, plug and play. And that does everything from all your core processing in the bank to your payments to all the surround solutions like cyber, deposit gathering, payments, all that type of stuff around it. And now that business normally, over time, it's actually a fascinating business. We did a podcast on, if you're interested, on business breakdowns, which is one of your, not one of your competitors' podcasts, but we actually break the business down, and it's actually a fascinating business based in Missouri, in a town of 10,000 people, listed in 1986. No one's really heard of it, and it's compounded its earnings at over 15% per annum since then. It's still only a $10, $11 billion business. It tends to grow earnings, low double digit through the cycle, and doesn't pretty uncyclical business. And normally that trades 30, 35 times earnings, and we've been sort of adding to its 26, 27 times earnings. That's the type of thing. What we're finding is some of those, what I call steady Eddie old technology, has kind of been left behind. Mm-hmm. And that's the opportunity for us to pick up something like that.
And has something gone wrong with the
business is performing exactly, it's actually performing very well. So record sales pipelines the last 2 years, delivering double-digit. We're not trying to fix something that's broken.
Yeah.
It's a 7 or 8% organic growth story. It gets a little bit of margin improvement, a little bit of buybacks. Tends to be a low double-digit compounder, negligible debt, 23% operating margin business.
Could you give us another idea?
Yeah, sure. Then another one that we've recently added to the portfolio. We do have a good overweight position in healthcare in the fund. We don't think in overweight, underweights, but we have a good position of the fund, about 25% allocated to healthcare. Now in healthcare, we don't go for the traditional things like pharmaceuticals or medical devices, but we do like animal healthcare a lot. So we have a company called Zoetis, number one in animal healthcare, but another one that we've added in that space is a company called IDEX, that's with 2 X's. So they do vet diagnostics. So when you go to the vet and you obviously want to do tests on your animal, obviously they're the ones who do it. Now, incredible market position, over 50% market share, incredible 80% of all the R&D spent in that industry is done by IDEX themselves. Mm-hmm. Again, terrific business economics. It tends to grow top line, high single digit, double digit organic revenue growth. It's high 20s operating margins. It's got a 45% return on invested capital. Just a really solid growth business. Unfortunately, those businesses always come at really high multiples. Actually, in the COVID bubble, it got up to, I think, 70 or 80 times earnings. And that's just been derating as the earnings have come through, and we picked it up towards the back end of last year at 30, 35 times earnings, which is still a full multiple.
Sounds pretty...
But it's, we've seen something like Jack Henry, I think at the peak of COVID, that nearly got up to 50 times earnings. Right. So there are parts of the market, as capital's going away into the more exciting parts, that will leave stuff behind. Yeah. And that's normally the opportunity for us to pick up names.
And these two names, size of the companies? What
10, 12 billion market caps.
Yeah.
IDEX is bigger than that. So IDEX is about 35 billion market cap.
US?
US, yeah.
Right. So quite sizable businesses.
Sizable, but in the context of the American market, more mid-cap really.
Yeah. Now, you mentioned earlier about the general market multiple being, 22 times, I think you said.
We use the S&P 500, as a proxy.
Yep. What about within your portfolio at the moment? Like, are you having to pay a bit more to own companies relative to history? Like, how much value are you seeing in the companies that you own?
So the news is pretty good. I mean, the way we think about it, we're trying to protect capital for clients in a down market. So the two ways you do that is quality. Yeah. So the quality across the portfolio is as good as it's ever been. You can measure, our return on invested capital, our operating margins are at all-time highs. So the quality is really good. But the second piece, is to your point, is the valuation. Now, we do have a chart that we publish, which is actually in our shareholder letter this year, where we have the price to value, and we value every single business. And where is the weighted number for the whole portfolio in terms of price to value? Now, the long run average has been about a 10% discount to value.
Yeah.
At the moment, we're about a 15% discount to value. So we're below the long run average. And then even just on a multiple basis, the portfolio we own today is actually trading about 10% below its 10-year average multiple, which is interesting because the market multiple is about 20 or 30% above its long run multiple. So we definitely feel good about the absolute valuation and feel very, very good about the relative valuation at the moment.
Yep. Have you been in a situation in the past where you've had metrics similar to what you've had today?
I think probably the closest parallel that I can think of is probably the late 90s, where you had a situation where sort of quality businesses kind of lagged a bit. It feels a little bit like that at the moment, where there's been a lot of excitement in certain parts of the market, and we've kind of been left out of that.
Sucks in the capital.
Sucks in the capital, and we've had opportunity. those businesses we've been following for years, like IDEX and Jack Henry, and then suddenly you get your opportunity and you can just nip in.
Yeah.
But even in the big names, last year we added Amazon. Now that's something we followed for a number of years. It was kind of on our B list. It got upgraded to the A list when they started to get much more stability in the margins and the free cash flow of that business. But that business used to be 80, 100 times earnings. We were able to pick it up at 30 times earnings last year. Yeah. So if you wait patiently, you get to know the business better and better over time, and then you get that window, and then that's when we normally swoop in.
Yeah. You talked about adding 4 positions to the portfolio last year. You can only hold 15 stocks. Yeah. Did something have to go to make room for it?
Yes, we took 2 out last year. We took out Nike, which we've obviously spoken about before, which was a mistake, which we exited that in July. And then we also took out LVMH, which we bought and sold successfully a number of times in the fund, not because we want to trade it, but because the share price had been quite volatile. And when that share price takes off and it goes well ahead of value, we will take it out. This time, actually, we didn't take it out on valuation. It was just that there had been such a surge in demand from China and COVID that the margins had really ramped up quite a bit, and we weren't quite 100% comfortable what the normal earnings of that business should be. And so those 2 came out, and other ones came in.
Okay. The other component of the portfolio, cash. How much are you holding right now?
We have 4% cash, which is where we normally run the portfolio.
Yep.
That can often be a good indicator of how we're feeling about the fund. So if that cash level, we can only go to 10%, but if that cash goes up close to 10%, it's a signal to our clients that we've sold something, we can't find anything good to buy, we'll let the cash go up naturally, and that's kind of what happened at the end of 2021, when the fund was up 42% that year, well ahead of the underlying growth in the business value. So we were letting businesses go, and the cash just rose naturally. Okay.
You've talked about that 10% number. That's the maximum hold position size for a single stock in the portfolio. Is anything at 10% at the moment, and why have you got so much conviction in it?
An old stalwart, been there 7 or 8 years now, Visa.
Yep.
That's close to 10%. It's actually suddenly just recently taken off. That's still there. Just produced another really, really good year. 7% increase in payment volume, translated into low double-digit revenue growth, mid-teens earnings growth. Again, this year we're looking at low double-digit revenue growth. About a third of that business now is value-added services and new flows. That's growing, high teens. The payment volumes are still growing high single-digit. 65% operating margins. Pretty much gives back all its free cash flow to shareholders. Just an amazing business because I've followed it for a long period of time, and it's amazing how I've seen it grow over time. It's I don't think, was it a 500 billion market cap now or more than that? And it's still delivering amazing business economics, still delivering the growth, becoming more relevant to customers. So that's why, it's still there.
Now, I know you tend to be calm by nature, pretty steady and level-headed. But when you look at your portfolio and you cast your mind forward, you're feeling bullish or bearish about, what's in there and what lies ahead.
The way we communicate with clients, so we target a return of 8 to 12% over 5 to 7 years. I would say we're somewhere in the middle or to the right of that equation. Where we stand at the moment, the market, the multiple on the fund is 26 times. That's actually below the 10-year average, but let's, for argument's sake, say we can hold that multiple.
Yep.
And our earnings forecast, so the businesses we own can grow double-digit. We hold the multiple, then we can get double-digit returns for clients, which is kind of what we want to do. So I feel, let's say, if you'd asked me this question at the end of 2021, I would have been very, very cautious.
Yeah.
Because that price to value gap had really closed. I think you did ask me actually. And by the end of 2022, I was super bullish because the price to value gap had really opened up. We're somewhere sort of between those two. So I feel pretty good. I feel very good where we are relative to the market.
Yep.
The quality is good. The valuation support is definitely there. But as always, there's always things to worry about out there, geopolitics, whatever, tariffs, whatever it is. Yeah.
There'll be a new one every day.
Yeah, there's a new one. Yeah.
All right, good. Well, Bob, it's been great to catch up. I'm very pleased to see that this time you don't have your shoulder in a sling.
I've got 2 brand new shoulders.
And you're fighting fit. As always, great to talk about some of the opportunities that are outside those big headline grabbing US stocks and learn a bit about the process at Claremont as well. So thanks for coming in.
Thanks, James.
Ladies and gentlemen, I hope you enjoyed that chat with Bob Desmond, Chief Investment Officer at Claremont Global. Remember, subscribe to our YouTube channel. We've got fresh content just like this dropping every week.